It's the first week of the month. You wake up, grab your phone, and open your banking app before you even get out of bed. Checking account, $126. In 2 days, your rent for a one-bedroom apartment will auto-draft for around $100 to $500. Pretty close to what a lot of people pay now. You scroll past a medical bill you've been ignoring, a credit card payment coming up, and a gas tank that's basically a quarter full. The same thought pops up again. I'll just put it on the card, again. Later that day, 2 texts hit your lock screen. Direct deposit posted. Your paycheck and your partner's almost $6,000 after taxes land in the same account. For a few minutes, it feels like you can breathe. Then the money starts disappearing. Rent, car payment, insurance, student loans, groceries, gas, a couple of subscriptions nobody remembers signing up for. If you feel like you work all month just to reset back to zero, you're not alone. Roughly 2/3 of Americans now live paycheck to paycheck. Even with 2 incomes, it still doesn't feel like enough. On paper, 2 incomes look safe. Together, you and your partner might make $80,000 or $90,000 a year. After taxes, around $5,000 to $6,000 shows up in your account every month. It sounds like you should be fine. It sounds like you should feel secure. By the way, my name's Dax. I make videos for people exactly in this spot. Working, trying, not lazy, but still feeling like money slips through their fingers. I'm not here to sell you anything. I'm here to walk through the math with you slowly so you can see what's really happening. Start with housing. Rent for a basic one-bedroom can easily sit around that $1,500 mark nationwide, and much higher in big cities. That's 1/3 of your take-home gone before groceries. Add a car payment, insurance, Garnier. There goes another big chunk. Then student loans. Credit cards. Phone, Wi-Fi, maybe a leftover medical bill. By the time you're done covering normal life, what's left for savings or emergencies is fragile. If it feels like one missed paycheck could break everything, it's because for millions of people, that's true. When people say it was easier back then, it's not just nostalgia. In your parents' or grandparents' time, a single income could often cover a modest house, 1 car, and raising kids. Wages weren't amazing, but housing, college, and healthcare were cheaper compared to what people earned. Since the late 1970s, worker productivity in the US has kept climbing, but typical wages have grown much more slowly, so most workers don't feel the benefit of that extra output. At the same time, home prices and rents have jumped far faster than many paychecks, with median asking rents for a basic place hovering around the mid-$1,400s to $1,500s nationwide in recent years. The floor of what you must pay just to exist keeps rising. That's the hidden logic of needing 2 incomes now. The second paycheck doesn't create extra comfort. It often just plugs the gap left by decades of slow wage growth and fast rising living costs. You and your partner aren't failing. You're trying to build a middle-class life on math that quietly stopped working years ago. You feel the trap most clearly in tiny, ordinary moments. Your manager hints about budget pressure, and your brain doesn't think about career growth. It jumps straight to rent. Because the rent is priced for 2 paychecks, the car notes are priced for 2. Even the neighborhood you picked assumes both of you keep working. One lost income doesn't mean cutting back. It means the whole equation stops working. I'm Dax, and I've been on both sides of that fear, the spreadsheets and the sick feeling in your stomach. When I was living with a roommate and both of us depended on every paycheck, one missed shift meant a late fee, not a minor inconvenience. It didn't feel like life was built on money. It felt like life was built on timing, the exact day rent hit, the exact hour direct deposit arrived. That's the quiet part of the 2-income trap. It doesn't just raise your lifestyle. It slowly raises the minimum cost of staying afloat, until normal only works if nothing goes seriously wrong. On paper, 2 incomes look strong. Together you might bring in $80,000 or $90,000 a year. After taxes, maybe $5,000 to $6,000 lands in your account every month. That number sounds solid, especially if you grew up in a house where nobody really talked about money and 6 figures was this magical line successful people crossed. But watch where that money actually goes. Housing is the first claim on your future. A basic 1-bedroom or a small 2-bedroom in many US cities can swallow 1/3, sometimes nearly half of your take-home pay. Then car payments and insurance eat another chunk. Not because you wanted something fancy, but because even average cars have turned into multi-$100 notes. Add student loans, minimums on credit cards, phone, internet, maybe a small medical bill you're quietly paying down. By the time you've covered the basics, the extra from the second paycheck isn't extra. It's the thin layer keeping you from slipping behind every single month, and you can feel how fragile it really is. The weakness of this setup only shows when something small goes wrong. An unexpected dentist bill, a flat tire that turns into a $900 repair. Your roommate moves out 2 months earlier than planned. None of these things are dramatic on their own. But when most of your income is already claimed by fixed bills, even a small surprise becomes a real problem. I remember staring at my own numbers once, trying to decide whether to fix the car properly or just hope it survived another month. I had done everything right that month, and somehow I was still choosing between safety and staying current on bills. That's when it really hit me. I wasn't building a life, I was just defending the current month, over and over, like a game that always resets to zero. In a two-income household, that feeling can double. Because the lifestyle was built around both paychecks, every shock lands on a thinner and thinner margin. The math technically works on paper, but only if nothing important breaks at the wrong time. If we zoom out from your checking account, the same pattern appears in how economies behave. You've probably heard words like inflation, interest rates, housing prices, exchange rates, liquidity, usually in a news clip you scroll past. They sound distant, but they describe the water you're swimming in. Inflation is simply how fast prices rise. Interest rates are the cost of borrowing those future dollars. Housing prices and rents decide how big a slice of your income must go to having a place to sleep. Exchange rates show how strong your currency is next to others, shaping the price of things we import, like electronics and gas. Liquidity is whether there's enough cash and credit in the system for payments to keep moving. When those numbers move slowly, you barely notice. When they move quickly, like after the pandemic, the change shows up in your life before you ever see it on a chart. The world quietly becomes more expensive, and your same two paychecks suddenly feel smaller. In the last few years, you might have noticed this whiplash. First, everything started costing more. Groceries, gas, rent, takeout. Then suddenly, every headline was about the Federal Reserve raising interest rates again. It feels abstract until you log in and see your credit card APR quietly jump. Or a car loan quote that makes you laugh because otherwise you might cry. From my side of the screen, as Dax, I watched the same charts you saw on social media, lines of prices and rates climbing faster than paychecks. But I also watched what it did to messages from people like you. More questions about minimum payments, more panic about expiring promos, more, is it just me or did everything get more expensive all at once? Two incomes didn't shield anyone from that. If anything, it locked more people into higher fixed costs right before borrowing got pricier. The system changed its settings, and households built on two paychecks felt the shock first, with almost no room to dodge it. There's another idea that sounds technical but shapes how fragile you feel. Liquidity. For a big bank, liquidity means, do we have enough cash or safe assets to meet payments when they come due? For a household, it's simpler. Do we have enough accessible money to handle a bad week without everything falling apart? When I plan my own finances now, I don't just think in terms of net worth. I think in terms of time. How many weeks could I pay rent, buy food, and cover the basics if both incomes stopped for a bit? Back when I was living month to month, the honest answer was, maybe half a month, if nothing else broke. That's not a cushion. That's a tightrope stretched over concrete. Two-income households often look richer on the outside, but many have very low liquidity. Lots of fixed payments, not much cash buffer. It's like owning a nice car with almost no gas in the tank. It feels impressive until you actually need to go somewhere fast and suddenly you're stuck on the shoulder. To see how this same logic plays out on a bigger stage, think about the Asian financial crisis in the late 1990s. Some countries in East and Southeast Asia had borrowed a lot in foreign currencies, while keeping their own currencies tied closely to the US dollar. That setup worked in good times. Then investors lost confidence, money rushed out, and those currencies suddenly dropped. When that happened, debts priced in dollars became much harder to pay back using weaker local money. Governments raised interest rates to defend their currencies, which slowed their economies and hurt jobs. The IMF stepped in with rescue packages, but the conditions often meant budget cuts and painful reforms. For families on the ground, it didn't feel like a currency crisis. It felt like layoffs, rising prices, and a future that suddenly seemed narrower. Just like a household, a country had built a life based on everything going right, and discovered what happens when the outside world changes the rules. Argentina shows what long, grinding inflation does to people. For decades, prices there have had a habit of rising faster than trust. Over and over, salaries lost value quickly, Savings in local currency were wiped out, and people watched the money they'd set aside shrink in real terms. Over time, many Argentines started treating their own currency as something to spend, not to save. Big purchases like apartments or cars were often priced in US dollars. Some people kept cash in dollars under the mattress or in foreign accounts, trying to protect themselves from their own system rather than from themselves. Others moved abroad entirely, exporting their skills just to import a little stability. Imagine living like that. Every paycheck comes in and your first thought isn't, what can I build, but how fast do I need to move this before it melts? That's inflation as a way of life. It turns everyone into a short-term thinker, not because they're irresponsible, but because the rules keep changing underneath them. Greece's debt crisis is another version of the same story. In the years after the global financial crisis, the Greek government struggled to pay what it owed. To secure bailout deals, it had to raise taxes and cut spending. On paper, those were fiscal reforms. On the street, it meant fewer public services, lower wages, and a lot less opportunity. Youth unemployment at one point climbed to shocking levels. Imagine graduating into a world where more than half of people your age who wanted work simply couldn't find it. You do the degree, send the resumes, show up for interviews that never lead anywhere, and slowly the idea that hard work pays off starts to feel like a story from another era. For young Greeks, the crisis didn't just take income. It took options. The ability to imagine a future inside their own country shrank. You can hear echoes of that feeling whenever someone your age in the US says, I did everything right, why does it still feel like there's no space for me? Turkey offers a more recent lesson. In the past decade, its currency has lost a lot of value against the dollar, and inflation has often stayed high. Prices go up fast, and the exchange rate moves in ways that make imported goods more expensive. To cool things down, the government has sometimes pushed interest rates very high, which brings its own pain. For everyday people, that means rent, groceries, and utilities don't just creep up, they lurch. A raise that looks good on paper can feel meaningless in a few months. Saving in the local currency feels risky, but earning in anything else is hard. It becomes a tug of war between today and tomorrow. When I, Dax, read messages from viewers in places like this, their questions sound a lot like yours, just turned up louder. How do I plan when everything keeps changing? How do I save when saving feels pointless? Different country, same core fear, that the ground under your life will not stay still long enough to build on. Venezuela is the extreme version of this story. Over the last decade, it has gone through periods of hyperinflation, where prices rose so fast that paychecks became nearly worthless in weeks. People carried stacks of bills that couldn't buy basic groceries. Shops started quoting prices in dollars because local money lost meaning, and saving in that currency felt like a slow-motion loss. In that environment, money stops being a store of value and becomes just a temporary coupon. The moment you get paid, the race begins. Buy food, buy essentials, convert what you can, before today's prices become tomorrow's joke. Many people left the country altogether, trading home for the hope of stability somewhere else. The US is not in that situation. Your dollars still hold value, but seeing the extreme helps you understand a softer version of the same anxiety. The sense that the system can change faster than you can adjust, and that simply working harder doesn't guarantee safety. In big crises, another term sometimes appears, CDS or credit default swaps. Stripped of jargon, they're like insurance contracts big investors use to bet on whether a company or country will fail to pay its debts. When fear rises, the cost of that insurance goes up, signaling that more people think default is possible. You don't buy CDS in your daily life, but you live a smaller version of the same story. When lenders think you're risky, they charge you more. That's what a low credit score really is, a signal that raises the price of borrowing. Higher APRs on your cards, tougher terms on auto loans, maybe no approval at all for the apartment you want. At the sovereign level, high CDS costs make it harder and more expensive for a country to borrow. At your level, high interest makes it harder and more expensive for you to escape debt. Different scale, same mechanism. When the system senses weakness, it quietly raises the price of being you, month after month, choice after choice. Back in the US, you see softer versions of all these patterns layered on top of each other. Home prices have climbed far faster than many starting salaries. Rents in a lot of cities feel like a second student loan. Healthcare bills can wipe out months of progress. None of this shows up clearly when someone just says, average income is X. When I look at the messages you send me, the same themes repeat. People in their early 20s who can't afford to move out without 2 or 3 roommates. Couples delaying kids because daycare would cost as much as rent. Graduates earning more than their parents did at the same age, but with housing and education that cost far more and interest rates that bite harder. This is why 2 incomes can still feel like not enough. You're not just supporting your current life. You're renting space in a system where the base price of ordinary has been quietly rising for decades, and nobody updated the story you were told about how adulthood should work. In big shocks, governments and central banks try to keep everything from snapping. In the US, that might mean stimulus checks, expanded unemployment benefits, pauses on student loan payments, or emergency programs to keep businesses alive. The Federal Reserve can cut or raise interest rates, buy bonds, and lend to banks to keep money flowing. You saw some of this during the pandemic. One year, people received extra cash in relief. A little later, they felt the other side of the medicine: higher inflation, then higher interest rates as the Fed tried to cool things down. From a distance, it looks like policy. Up close, it's your rent, your groceries, your credit card bill, and whether you can finally breathe this month. As Dax, I try to be honest about this. Policy can soften blows and prevent collapse, but it rarely makes individual lives feel easy. It's like putting guardrails on a highway. They keep the worst crashes from happening, but they don't smooth out every pothole you hit along the way. So where does that leave you, sitting with your phone, 2 deposits, and a list of bills that feel heavier than the numbers? The goal isn't to beat the system. It's to make your own life less fragile inside it. And the place I start, both for myself and for this channel, is fixed costs. Housing and cars are the biggest anchors. Staying with roommates longer than you planned, picking a simpler apartment, or living a little farther from the trendy area doesn't mean you're failing at adulthood. It means you're buying flexibility in a world that keeps trying to sell you commitments. The same with cars. A boring, reliable used car with no payment often beats a shiny new one with a $600 note. When I finally moved into a place that was less impressive but less expensive, my stress dropped more than any raise had ever done. It didn't make me rich. It just made the next bad week survivable without reaching for the card every time, and that tiny shift changed how I slept at night. After fixed costs, the next layer of defense is how you treat debt and savings. High-interest credit cards are like tiny holes in the bottom of your bucket. You can pour in 2 incomes and still feel like the water never rises. The math is brutal. When your APR is in the high teens or 20s, most of your minimum payment is rent you pay to the past. If you can, even a small extra amount toward the highest interest card each month starts to tilt the math back in your favor. $20 or $50 doesn't feel powerful, but over time it shortens how long that debt owns you. With student loans, learning your repayment options and getting your monthly number clear on paper can turn a fog of dread into something you can at least plan around. For savings, I don't start with 3 to 6 months. I start with 1 bad week, enough to cover rent, food, and gas if something goes wrong. That first tiny buffer is less about the amount and more about breaking the feeling that one surprise can erase you. Underneath all the acronyms, charts, and case studies, this comes back to something simple: control. Not control over the whole system. None of us have that. But control over how exposed you are inside it. 2 incomes in today's America don't guarantee comfort. Sometimes they just build a taller, nicer-looking cage. You didn't create the housing market. You didn't design student loans or medical billing. You were handed a rulebook written for a different era and told that if you followed it, you'd feel stable. If you've done that and still feel anxious every payday, that isn't a personal failure. That's evidence that the rulebook is outdated. What you can do is slowly rewrite your own version. Lower fixed costs where you can. Be deliberate about debt. Build tiny pockets of liquidity. Measure progress not just by income, but by how many shocks you could survive. You don't have to win at money to change your life. You just have to move, piece by piece, from a life that breaks easily to a life that bends and holds.